We'll stand up for the prayers, please. Thank you.
साक्षात् परब्रह्म तस्मै श्री गुरवे नमः। विघ्नेशानमुनि गुरु सस्मरुनि लक्ष्मी स आवाहिले। आम्ही गुंतवणूक शास्त्र शिकण्या हे सत्र आरंभिले। केव्हा स्थावर आणि जंगम कधी कोठे किती गुंतवू। चर्चा मंथन तज्ञ बोध मिळता हे प्रश्नही सोडवू। ठेवी भाग सुवर्ण पोस्ट अथवा रोखे तसे फंड ते। वृद्धी भांडवली मिळो कर नको पर्याय हो कोणते। कोठे उत्तम रोखता सुगमता लाभांश वा व्याजही। कोठे गुंतविणे सुरक्षित असे नोंदीस कैसी वही। सन्मार्गे धन संपदा मिळविणे अत्यंत आवश्यक। पैसा ध्येय नसे म्हणून जपणे जाणीव सामाजिक। ज्ञानाचा उपयोग गुंतवणुकी साठी सदा होऊ दे। हे सारे समजावया सुमती दे आम्हास तू शारदे।
Once again, markets are scaling new heights, and for every 100 points fall, it jumps by 200 points. So that definitely creates a lot of anxiety in the minds of the people. And to address such things, and also the interim budget which was presented recently on 1st of February, we have Mr. Ajay Bodke with us. I'll just start with a brief introduction about him. He's an independent market analyst. He is one of our preferred speakers and a regular faculty at P.V. Bhagwat Investment Guidance Cell. He has around 29 years of experience as a senior portfolio manager with a leading India's mutual funds like IDFC Mutual Fund, Standard Chartered and SBI. He has also played an important role of being a CEO of Chief Portfolio Manager with Prabhudas Liladhar. And his role was basically spearheading the investment management for portfolios and designing strategies with respect to asset allocation, sectoral allocation, etc. Under his leadership, investment and grew almost 8 folds with Prabhudas Liladhar. That was between 2013 to 2020. Post that he's been independent market analyst. He was ranked one of the top 10 fund managers by one of the India's leading financial newspaper, first ever rating for mutual fund managers, and also recognized as India's best money manager by the leading capital market magazines. He is a regular speaker at Money Control, CNBC, and he has been contributing several articles to Economic Times, Business Standard, Mint, The Print, and Money Control. He is a mechanical engineer from Government College of Engineering, Pune, and holds a Master's in Financial Management as well as a Master's in Business Administration from Macquarie Graduate School, Sydney. Let us welcome Mr. Ajay Bodke to enlighten us on the outlook towards economy in the light of this interim budget as well as the market at this juncture. Before handing over the mic to Ajay, I would like to felicitate him by offering a small memento. I'll request Mr. Uday Tadwarkar to. So the floor is all yours, Ajay.
Thank Thank you very much for inviting me. As I mentioning to Dere sir as well as Mr. Dhruv, this is the fourth time that I have had the honor of being invited at Lokmanya Seva Sangh's investment cell. I recollect, I think one of the times was once we had a finance fair. I think I had also participated in a debate at that point in time. That was, I think, 6 or 7 years back. I think the way I intend to structure this is because we've just had the interim budget a couple of days back. Am I audible till the end? Yeah. I'll dwell first on what is the what are the underlying assumptions, for the fiscal math that the finance minister has arrived at for the budget. How achievable are the assumptions? And then we'll also get into the global economy, some of the key points, highlights out there, and how do they impinge the liquidity in the Indian economy, the Indian stock markets, and then we'll also look at some of the sectoral trends in the market. I would like to keep this session interactive, so in case there are any questions, I think I'll welcome any one of you to immediately raise the questions, and we can try to address those questions immediately. So the basic building block for any budget is the assumption of nominal GDP growth that the government of India bases the numbers on. So if you look at the budget for 2025, the government is assuming a 10.5% nominal growth in GDP over the last financial year. This is a slight improvement over what was achieved in the last financial year. If you look at the tax and the non-tax revenues, how do they stack up? So the budget basically assumes that the gross tax receipts will increase by around 14%. Now within the gross tax receipts, there are 4 or 5 main headings. So the assumption is that the income tax will grow by, or the assumption is that it will grow by 28.4%. And I'm talking about the comparison between the budgeted estimates for FY25 vis-a-vis the budgeted estimates for FY24. The corporate tax growth has been assumed at a more sedate 13%, GST growth at 11.6%, whereas the other two smaller contributors, namely customs duty and excise duty, customs has been assumed to be broadly flat, a drop of 0.8%, and excise duty a drop of around 6%. So all of it, the agglomeration of all of this essentially leads to the gross tax receipts being higher by 14%. Now, the revenue receipts to the center, when I refer to, that also has been assumed to grow at around 11.6%. So the gross tax receipts, what happens is certain amount as per Finance Commission's report is to be given to states. So net to center, what is retained by center, the tax receipts are assumed to grow at 11.6%. The assumption insofar as non-tax revenues are concerned, and I'll come to that in a while, what does non-tax revenue mean? It essentially means the dividend that the government gets from all the public sector undertakings, public sector banks, and what is called the old lady on the Mint Street, which is the RBI. What is the dividend comes from RBI? And then there are other contributors, main contributors like telecom sector. So whatever are the auctions for telecom licenses that are done every year, plus the regular revenues that, for every call that you make, certain amount just goes to the government. So those regular receipts and these auction proceeds, they also contribute to non-tax revenues. These are main contributors. And the assumptions underlying these non-tax revenue items are, in my opinion, on the higher side. And that's why 32% growth in non-tax revenues is what the assumption is for the government. So tax revenues 11.6%, net to center, non-tax 32%. Now let's come to the expenditure side. Now through use of some magic wand, the bureaucrats have ensured that the revenue expenditure, which is the mainstay, nearly 75% of total expenditure of the government is revenue expenditure. Interest payments, salaries, pensions, establishment expenses, they are assumed to grow at only 4.6%. Now here, from 35 lakh crores, what the government had budgeted last year, to around 36.5 lakh crores. Now within revenue expenditure, interest is the largest component. And interest that the government pays to the lenders, to the government, is expected to grow by 10%. And that will contribute 12 lakh crores. Now, remember this number, 12 lakh crores is what the government of India pays on an annual basis as interest. Why this is important is because total tax receipts in the year is only 26 lakh crores. Tax receipts. And we'll come to the deficit and all those numbers. I'll put it in very simple terms what deficit is. Because these are jargon that economists use. So what does it actually mean? We'll come to that. And then that will really bring home the point about how strong or otherwise is the fiscal position of the government. Now revenue expenditure, as I said, is around 36 lakh crores. Now if you look at the capital expenditure, which is essentially the money that goes into productive assets, building roads, railways, capital expenditure for defense, and the other 6.7 lakh to 15 lakh. I'm just rounding up the numbers. So roughly 9% growth. So revenue expenditure growth is 4.5%, capital expenditure is 9%, but revenue expenditure is 36 lakh crores and capital expenditure is 15 lakh crores. So you can look at the total expenditure breakup, 75-25. So now we come to fiscal deficit. Now this is a term that all of us hear so often. But what is fiscal deficit? So first I'll come to what exactly the number is. The fiscal deficit projected by the government is roughly 16.85 lakh crores. Let's say 17 lakh crores is the fiscal deficit. On a GDP, they say, typically they always talk about it as a percentage of GDP. So they are saying it will be 5.1% of the expected GDP for the current financial year, it is FY25, which is projected to be roughly 327 lakh crores. What is GDP? It is nothing but sigma or addition of the income of all the citizens of the country. So 140 crore Indians, whatever is their income, goods, services, broadly, that's GDP. Or in economic terms, it is nothing but consumption plus investments plus net exports. Exports minus imports. That is the total income. And when I say investments by government, investment by private sector, that's put together consumption by all of us and exports minus imports. That's the GDP. It's the income for the country as a whole, for all the citizens. So typically governments would like to talk always in terms of we have reduced fiscal deficit from 5.8% to 5.1. That's what the government has said. But what is the fiscal deficit? 17 lakh crores. Now what is important to know, government is earning 30.8 lakh crores expected to earn this year. 31 lakh crore, 31 roughly. Out of which, as I said, 4 lakh crores is the investment, is the income from dividends and from RBI, public sector companies plus the telecom receipts. And roughly 50,000 crores is coming from what critics would say selling of family silver, which is divestments of partial or controlling stake in public sector undertakings, 50,000 crores. So 4 plus 50,000, so 4.5 lakh crores roughly is non-tax revenues plus divestment proceeds, which means the rest is revenue expenditure, roughly around 25.5 lakhs, if you remove 4.5 lakhs from 30 lakhs. So recurring revenue receipts from tax, different types of taxes is 25.5 lakh crores. And the expenditure is 47 lakh crores. So it's like an individual, monthly I am earning 30,000 rupees and monthly I am spending 47,000 rupees. So every month or every year, let's say 30 lakh rupees I am earning a year, 47 lakh rupees I am spending in a year. So what is happening is 17 lakh rupees is fiscal deficit, excess of expenditure over income. And that 17 lakh rupees the government comes to all of us and the banks and the post savings to borrow. So I was fortunate to know Dr. S. Tarapur. He is no more. He was RBI Deputy Governor and one of the finest minds in macroeconomics. So he used to tell me, Ajay, don't ever look at fiscal deficit as a percentage of GDP. Why? Because GDP is a number which is based on a lot of imprecise factors that you calculate. Calculating the income of the country is based on a lot of assumptions. And also it's very complex, especially in a data poor country like India, where unlike the West, where there's a lot of rigor in terms of maintaining data. So don't look at fiscal deficit as percentage of GDP. Simply look at fiscal deficit as percentage of, look at the P&L account of the government. I'm earning 31 lakh rupees. I'm spending 47 lakh rupees a year. That's why I'm ending up borrowing 17 lakh rupees every year, this year, coming year, from the market. So look at it from that perspective. And when I look at it from that perspective, I think the situation is quite sobering and quite gloomy. You simply substitute the government of India by an individual. 30 lakh rupees of earnings, 47 lakh rupees of expenditure. As they say, once you start borrowing, if the borrowing keeps on increasing every year, then the lender starts getting worried that will this borrower be able to repay in time? And the cost of borrowing goes up. So you are earning 26 lakh in tax revenues, overall 31 lakhs, and you are paying 10 lakh rupees as interest every year. Substitute that person, the government is individual, and think 30 lakh of total earnings, 26 lakh of recurring earnings. For me, 11 lakh I am paying as interest, and my expense is 47 lakh. So from that perspective, always look at fiscal deficit as percent and compare it with the recurring tax revenues of the government. That's the first point I want to make. Now, let's look at the positive aspect about this government is its relentless focus on hard infrastructure, creating hard, when I say hard infrastructure, the massive investments that they have done in the last 10 years in roads, in railways, power transmission. The investments in fact have gone up, if you just were to take a 10-year perspective, by multiple times. In some sectors like roads and railways, it could be in the order of 4 to 5 times the investments have gone up. Of course, the funding for that has come from the refusal of the government to reduce petrol and diesel prices. So the excise duties have gone up, mainly in form of cesses. Why cesses? Because when you impose a cess, you don't have to share cess with the state government. Other taxes have to be shared in the proportion of 41% goes to the states, the rest remains with center. So the moment you impose a cess, then the entire cess remains with the central government. But to be fair to them, they have used these large inflows to fund capital investments in roads and railways. So every year, I think they have been increasing the capital expenditure in these two sectors. Why it is important is because the economic multiplier impact of every rupee that you invest in a road or railways, transportation sector, is 4 to 5 times in the medium term, or 5 to 7 years. Because your economic activity goes up, the places that you are connecting, your logistic costs come down, your export competitiveness goes up, and more economic activity starts happening in areas that get connected. The produce of the farmers can reach the mandis in time, and that can improve efficiency in the economy. So that's why it's important that you invest in roads and railways and other sectors like ports, airports, etc. Now here, I think if you look at how has the investment been in this year, in this budget. But before that, we look at the borrowings part. Now, one of the, all of you must have, after the budget is announced, I think, a lot of corporate biggies, they vie with each other to come on different media, electronic channels, or they write articles, and almost all of them, whichever government be in power, they can't stop praising, I think, the proposals that have been put forth by the government, whichever government is in power. Now, there are certain comparisons that they have, but as independent analysts and investors, we must always have a healthy dose of skepticism, not cynicism, but skepticism as an investor or as a fund manager or as an analyst. You must always look at the numbers and see what does the data tell you, because you must always be guided by data and not by emotions. And there if you see, as I said, a lot of analysts said that a lot of crowding in of investments will happen from private sector. What does crowding in mean? Is every year there is a limited pool of savings that you have as a country. If the government borrows more out of them, then less is available for private sector to invest. So that's why it's important that the government lives within its means. What it means is increase your income, reduce your expenditure, reduce the deficit, which means more savings will be available for productive sector of the economy, for corporate sector, for individuals to take mortgages, auto loans, personal loans, for companies to make investments in plants and machinery, in logistics, in warehousing. So the overall private sector capex, if more funds are available there, the cost of funds will go down in the economy. That's important. That's why it's important that the government learns to live within its means. Now here you see, the government has said that the gross borrowing will come down from 15.5 lakh crores FY24 to 14.13 lakh crores. 1.5 lakh. It's a big amount. But then you look at net borrowings. This is gross borrowing. Net borrowing means net of the repayments. Whatever sum that you have borrowed, you have to repay every year. On net basis, the borrowing has come down from 11.8 lakh crores to 11.75 lakh crores. 5,000 crores. 1.5 lakh crores on gross and only 5,000 crores on net. You know the implication of that. Number two is the government, to be fair, has reduced fiscal deficit from 5.8%, they intend to reduce to 5.1%. Now on 327 lakh crores, 0.7% roughly comes to 2.29 lakh crores. So had the government not reduced the fiscal deficit and theoretically kept it at the same level, then it would ended up borrowing 2.29 lakh crores more. But if that had happened, then the cost of funds in the economy would have gone up, the credit rating could have come under would have been adversely affected, and investor sentiment would have taken a beating. So that's why the government over time has to reduce fiscal deficit. Now, before COVID, the government has said that we will bring it down to 3% of GDP. It is 5.8 and they intend to bring it down to 5.1, and they said you also want to bring it down to 4.5 a year later. But that is still far higher than pre-COVID commitment of 3%. So let's look at the assurances in light of what was assured before COVID. Understandably, during COVID, it had to go up because the government had to pump-prime the economy. But now that the economy will be the fastest growing large emerging economy, so you also need now to put your finances in order and aggressively start reducing fiscal deficit. Now let's look at roads and railways. How has the allocation been? Because these have been the sectors which stand out. They are the twin engines of growth that I call. In railways, last year the government had committed 2.4 lakh crores. Has it gone up this year? It has gone up to 2.5 lakh crores. A growth of 5%. Roads, again a second engine of growth. Last year, the government had budgeted 2.76 lakh crores. This year, it's gone up by 1,000 crores. 2.77 lakh crores, a growth of measly 0.3%. 0.3% growth in roads allocation, capital allocation, and 5% for railways capital allocation, budget estimates vis-a-vis budget estimates. Defense. I think the market is extremely enthusiastic about defense, railways, space, and we'll come to the valuations a bit later. How has the capital allocation been in defense? Atmanirbhar Bharat. From 1.62 lakh crores in FY24 budget estimates, it has gone to 1.72 lakh crores, 10,000 crores, a growth of 0.36%. Capex in defense. Now, of course, all of us know that the urban economy is doing better, and within urban, you must have heard about the word called K-shaped recovery. K. So a small sliver of 10-20% of Indians are doing exceedingly well. That's what the postulation is. And the rest, lower middle classes, poor, they are not doing as well. So the income inequality and the wealth inequality is increasing massively in last 5-7 years, not only in India, but globally. And within India, the rural sector, the demand is tepid, anemic. You look at any sector, the higher end, luxury segment, consumer durables, consumer non-durables, housing, you take any sector, you'll find that SUVs are selling like hotcakes, but the entry-level cars are not selling at the same clip. Hero Motors is not doing as well as Eicher. Higher end bikes are selling. The same is true in case of consumer durables, washing machines, television sets, refrigerators, or in case of even consumer non-durables, FMCG goods. There's a down trading that is happening. The people who can't afford because of higher inflationary pressures, they're down trading, or the pack sizes are reducing. But at the higher end, I think it's doing roaring business. I think if you look at people who are traveling abroad, I think the numbers have gone up. So that K-shaped recovery is coming into play in India like it is in many other countries. Why? Because in last post-COVID, the financial sector assets have done extremely well, and so has real estate to a certain extent. And as a result, that percentage of population that owns financial assets, so the wealth effect has played out, not so much income effect. Income effect has played out only in certain sectors. So I'm just tying it up with the allocation to agriculture sector, rural sector. Now, if you look at the aggregate demand in rural sector, that is tepid, and there's pressure on incomes. So in such a situation, we would think that the fertilizer subsidies would have gone up because annadatas have to be taken care of. The subsidy on urea has gone down from 1.25 lakh crores to 1.19 lakh crores, and the nutrient-based subsidy, which is for the non-urea NPK, has gone down from 60,000 crores to 40,000 crores. Let's come to food subsidy. Now, of course, there is an announcement of 80 crore Indians will be given free rations for 5 years, an extremely good welfare measure. But what does it speak about the fact that you have to actually roll out such a measure for 80 crore Indians out of 140 crore Indians? Food subsidy has broadly remained flat from 2.11 lakh crores in last budget. It will grow to, it will come down to 2 lakh 5,000 crores. By 6,000 crores it will come down. And this time round, the entire food subsidy bill will be routed through Pradhan Mantri Garib Kalyan Anna Yojana. There were some 2 other headings. They have scrapped them and now everything will be routed through this. The petroleum sector is very critical because whenever crude prices go up, we call upon all the OMCs, IOC, HP and BP to be counted and do national duty, which basically means don't increase the prices, especially if state elections are close by. Every government does that. So now, the capital subsidy for these 3 companies has gone down from 30,000 crores to 15,000 crores. I am tying it all up with how that 4.9% increase in expenditure has been arrived at. The total expenditure has been assumed to increase by 4.9 crores because there has been so much of, in my estimate, conservatism in budgeting for many of these line items. And yet deficit is 17 lakh crores. Income of 30, expenditure of 47 lakh crores. Now, what about the LPG and the direct benefit transfer to poor households for LPG? From 9,960 crores, it has gone up by 6% to 10,594 crores. All of us are investors. All of us should be extremely happy because the markets have done exceedingly well in the current financial year. Nifty would have gone up upwards of more than 20%. And if you were invested in mid caps and small caps, 50 and 65% roughly, the index. Now in view of that, the guys sitting in the divestment department, this investment department, they should have been active and selling the government stakes. Anyway, BPCL is not going to happen. Shipping Corporation, nothing heard. Concor, nothing heard. Sorry, IDBI and two other banks, nothing about it. So, but at least partial stake sales, because what happens is all the bureaucrats, for all the bravado, they're all scared that in case they decide to go in for a strategic sale, then 10, 20 years down the line, some CAG report or a CBC report or investigative agencies will come knocking on their doors when the gentleman basically must be 75, 15 years after retirement, and will have to answer for alleged wrong deeds did 15 years back. So no bureaucrat, whatever he might say on CNBC, would like to go for strategic sales. They want to play safe. Air India happened because you had Tata's on the other side. So no one can of course object Tata's sort of, being the strategic buyers. And this is a reality. That's why for the last 10 years, be it Manmohan or Modi, the divestment proceeds have always fallen far short of what they assumed. Because finally bureaucrats don't want to push for strategic sales. So that's why then what do? You sell partial stakes in certain companies. At least that they should have done better. They had budgeted 61,000 crores. And how much did they do? 30,000 crores when the market is booming. And private sector guys have sold shares worth 1.6 lakh crores. All the private equity guys, venture capital funds, plus promoters of companies, block deals that you hear, 1.6 lakh crores they have sold in last 1 year. And government of India has sold only 30,000 crores when they were committed to sell 60,000 crores. But then hope springs eternal. So every year they say that no, this was underachievement, now we overachieve. So now next year they budgeted 50,000 crores. So income, you are confident. Expenditure, you try to be more conservative. Now on the income side, dividends from PSUs and public sector banks were budgeted at 43,000 crores last financial year. They actually have done 50,000 crores, the revised estimate. Next year, they are more or less flat, 48,000 crores. They have been conservative there. But then RBI continues to show its benevolence towards the government. Budgeted number of dividend was around 48,000 crores, and RBI has given 1.04 lakh crores as dividend to the government. And this year, the bounty continues, and they are going to give 1.02 lakh crores, the budgeted number, from dividend from RBI. And lastly, I think to wrap up this discussion on budget, as I told you, telecom sector, the recurring revenues and the auction proceeds, they had budgeted them at around 89,000 crores in last budget. They actually have done to 93.5 thousand crores. And vis-a-vis that 90,000 crores, this year they are assuming 1.2 lakh crores. So roughly, that's a massive increase vis-a-vis 90,000 crores that you are assuming. Around 40,000 crores of increase you are assuming on telecom from the communication sector. So basically, this sums up the major salient points in the budget. So if there are any questions, I can take them now, or then I'll proceed to the next major topic about global macroeconomy, its impact on India, Indian economy and markets. So I assume, yeah. You can please have a seat. I can hear you audible. Please have a seat. Please have a seat, sir. Yeah.
Sorry, I'm a little bit late.
Yes.
There's always been a question, whichever government come, whichever politicians come, very smart people, smart and use everything. Out of 141 crore people, 4% will pay income tax. I'm proud person that I'm my
All of us pay income tax, I think, in this room.
only 4%. I'm not completed sir, my question. Out of that 2.7% actively pay income tax, rest of them file returns. There's a vast difference.
Yes.
Which you know better than me. This
I'll, yeah, understand. Yeah, yeah. So tackle the second question first. I don't see any political will, whatever be the ideological hue of the party in power. You could have a party which is right of center or left of center. None of them have the political will to even contemplate a proposal to start taxing rich farmers. The backlash that they fear, because we already have seen that very well the farm laws that were introduced by the government were well-meaning, would have led to improvement in productivity. Also, a lot of leakages would have got plugged. The arthiyas, sort of, who are the middlemen, I think they lobbied hard through the farmers, in scuppering the farm laws. So the backlash, the intense lobby among people who benefit from keeping the entire category of farmers out of income tax bracket is too strong. So I don't see that happening anytime in future. Whether if you were to bring the rich farmers into the taxation fold, 90% of fiscal deficit would get addressed is something I have no reply to, because no calculations have been done to that extent, and it's a matter of speculation. The first part that you mentioned about the rising wealth and income divide is something which I feel passionate about, because I believe that for sustainable growth in any economy, only a small sliver of people contributing to consumption is not going to suffice beyond a point. And in my opinion, we are slowly approaching a level where the trickle-down effects is what a lot of governments talk about. We need to do a lot more for that. Welfareism is fine. Handing freebies is fine. You could call them ravedees. You could call them in some other term which is not as pejorative or as condescending. Because every political party, whatever be the ideological inclination, believes that by giving more and more freebies, I think previously only in southern state of Tamil Nadu, you thought that there will be comparative politics. If one party were to give, say, bicycles, the other would give pressure cookers. But now I think it's become something that's afflicting the entire country. And all parties are, they've realized, Karnataka elections is a clear example where there's competitive populism. And another trend which is reverting back to OPS, which is again going, which there was a consensus among political parties, the Congress and the BJP, that we need to move to the new pension policy. But now suddenly I think there is a clamor that you go back to OPS. Again, why? Because it's easy to reach out to people, appeal to their baser instincts, and then the idea is to win elections at any cost, whichever political party it could be. And so this, coming to a question about economic disparity, I think I gave you examples about sector after sector. It is being seen that the affluent, the consumption among the affluent class and goods, I think it's growing at a very rapid clip. Whereas the consumption in case of poor and low middle classes, see, let's not forget there have been three very large exogenous shocks. The first was demonetization, in which hundreds of thousands, if not thousands, of MSMEs, I think, were very badly affected. There was a need to address tax arbitrage issue. Those businesses that are only thriving on tax arbitrage by not paying whatever the taxes due. And if they were in small and tiny and medium sector, that had to be addressed. But the employment loss was massive. And most of these guys, they did not have credit history strong enough to go to larger banks and sort of, ask them to tide over the crisis. There were programs rolled out, but yet a large number of MSMEs, they fell by the wayside. And as a result, the employment prospects of lakhs of people who were employed by them and the suppliers to them, vendors, got impacted. The big became bigger. The large became mega large. Again, sort of, coming to the same issue that you raised. The second exogenous shock, of course, was this tax arbitrage was, I'm so sorry, not for demon, it was mainly for the GST, which was rolled out 3 or 6 months after the demon. November 16 was demon, and then I think a few months later GST, which extremely necessary because, a lot of inefficiencies in costs were addressed. You need not have depots in every state. Sort of, you can, economies of scale came into play. Manufacturing, there's no necessary, to have manufacturing in different places. You could have in a few places where your cost could go down, economies of scale could come into play. So the second exogenous shock was roll of GST. And the third was COVID. So these three shocks have actually dealt a body blow to income streams of crores of poor and lower middle classes. But because of a torrent of liquidity that is coming to the Indian stock markets, I think those who own financial assets have benefited massively or disproportionately. And typically, we tend to look at people around us who are like us and then draw a conclusion about how the economy is doing or how sort of, the circumstances are. So I think I helped address that question. Yeah, so now I think, let's go to how are the things from the market's perspective. After COVID, when almost all the economies had come to a standstill, the governments in various countries felt that you needed to provide support, what is called pump priming the economy. So they gave a carte blanche, and they told the central banks that you can now not only reduce interest rates to 0%, which they did, America, Europe, UK, many countries followed suit, large economies. They brought down the interest rates to give monetary stimulus. So if you bring down interest rates, people will feel more emboldened to go and buy a house or buy a car or for personal loans. So consumption activity goes up if you bring down interest rates, or businesses get incentivized to put in more capacities, for their capital expenditure because the cost of funds is low. But in addition to that, they also told them that you can now print money, which is called quantitative easing, QE. So the American Central Bank or Fed had a balance sheet size of 800 billion before Lehman. It had gone during Lehman to 4 trillion. So 800 billion had become 4,000 billion by Lehman. And then they were planning to bring that down because that is essentially money that you have printed. So you need to bring it down and bring it back to ideally to zero over time. But then COVID happened. So that 4 trillion from 800 to 4 trillion had happened from 2008 till 2020. In a matter of 2 years, it has gone to 9 trillion. So look at the amount of money that actually was printed by US Fed. And ECB followed. They did a similar printing of euros. UK did. Australia did. So every central bank on earth essentially lowered interest rates to zero and started printing money. And Bank of Japan never stopped. They were the first ones to start and they never stopped. Even today they are doing it. The others at least have, as a token, they are saying now we'll try to reduce the money supply. What is inflation? More money chasing less goods. Because you cannot increase overnight the total production capacity of a country. Whatever you are a farmer, unless there is some great technological breakthrough, whatever is your output, that will remain more or less same. It will increase slightly with better fertilizer, better irrigation. But suddenly if you have more money chasing those goods of that farmer, he will increase the price of his produce. This is what essentially has happened globally. Why has inflation become unhinged? Which was so low and suddenly inflation has become a problem. Of course, supply chain that were jammed after COVID added to that because there was no supply coming in, and demand, everyone was sitting home and getting these inflows from various governments. India didn't do that as much. So that's why inflation became unbearably high in developed world. And then the only way the central banks know to reduce inflation is to slam the brakes, to increase the cost of funds. That's from 0% they went to 5% from in matter of hardly 15, 18 months. And they also said that we'll try to reduce money supply. But they tried to do that, and the entire financial system is so fragile today. The debt levels have gone up so much that any small shock can create tremors that will flow across the globe, and if you have a chain, the weakest link of that chain, if it gives way, the entire chain breaks. Similarly, we don't know in this entire financial chain which companies have taken large loans and they're hidden. Because banks are regulated, but after Lehman, but the shadow banking sector, non-banking sector as you call it, in hedge funds, alternate investment funds, globally I'm talking about, or some of the family offices which also borrow, the leverage levels are so high that any large withdrawal of liquidity, their business models could shake and could even sink. So all of them immediately start appealing to the central banks and the government, mainly through senators, parliamentarians in India, that please try to restrain the central banks, because no one wants, as they say, when there's a party on and everyone is drinking, and there's a punch bowl. So there's a punch bowl, everyone starts drinking to the punch bowl. So if you want a good central banker knows when to remove that punch bowl. Otherwise everyone will be drunk and everyone sort of would fall. But this is what, moment the central bank tries to remove the punch bowl, all these people who have vested interests, they start pressurizing through the politicians that no, I think the whole system could collapse. But this is becoming more and more unsustainable. 800 billion of debt gone to 4 trillion in 2010 is to around 8.5 to 8 trillion today. And this is only America. Similar increase has been seen in case of Europe, in UK, every country, Japan. Today, do you know that the Japanese central bank owns 50% of all the outstanding central bank securities of Japan? Because they are the ones who keep on buying. They can't continue to do that. At some point, they have to unwind it. So the bottom line I'm saying is that is the whole global system is awash with liquidity. This is nothing but money printed out of thin air. I call them funny money or helicopter money. Because Ben Bernanke had said once that if the economy is not doing well, just take a helicopter and just drop dollars. And then if everyone has dollars, he'll go and buy a washing machine, he'll go and buy automobile and so on. But finally, when the time of reckoning comes, the debts have to be repaid. And this is what happens, the value of your currency goes down. This is called I'll get that word. So essentially the buying power of your currency goes down because you're printing so much currency. Devaluation of course will follow. There is debasement of currency. You're debasing that currency. So anyway, coming to India, now of course post-COVID, I think India did not follow the same path as many developed countries in terms of printing money. That's also because we were concerned about a credit rating, which anyway was precariously, which was not very strong. So we took a measured approach. We basically, instead of giving direct transfer, we tried to help some of the companies to protect employment, and plus targeted subsidies we gave. So that's why our fiscal deficit deteriorated, but not as much as the developed world. The withdrawal, of course, was far more measured. And if you remember, there is a law, the parliament has told RBI that your inflation should not be more than 4%. Only in extraordinary times, you are allowed to go to that band of 6 and 2. But extraordinary times are over. They should have by now brought it down to 4% because inflation hurts poor the most. Rich, it doesn't hurt. Why? Because large part of a poor person or middle class person's income goes for essential goods, to pay rent, to buy basic necessities, and then whatever remains. So if inflation erodes the value of his essential purchases more than a rich person. So that's why it's important that inflation is brought down to that 4% level, as soon as possible and kept sustained on a certain basis kept out there. We are on the path, but it's taking time. Now we got large inflows because we become a darling of the market, of the world. We are the fastest growing economy among the larger emerging economies. And we have seen the Nifty, which had fallen from 12,400 in February 2020 to it plunged to 8,500, and intraday it had gone to 7,500 intraday. So 8,500 has now gone to 22,000 roughly. That's give and take a few hundred points. That's a massive jump. So even if COVID had not happened, from 12.5 we are at 22, and because of COVID from the bottom, point to point from 8.5 we are at 22. But that is not the whole story. The story lies also in small and mid caps, where the index itself has jumped more than 4 or 5 times. Large amount of money through SIPs is now flowing into small and mid caps in last 1 year. There's a recency effect in psychology. So if something is done well, you think that it will continue to do well. Some statistics I want to talk about from the market. If you look at the Indian small cap index, it's already delivered a CAGR of around 25%, both on a 5 and 10 year time frame. 25% per annum return over a 10-year time frame is already returned. And the micro cap index fund, which is smaller companies still, now in last 6 months it's actually gone bonkers, and it's been returning basically 501 companies, market cap below 501 companies, and they've been giving 1% return roughly, I think, almost daily basis. That kind of madness we are seeing in the micro cap sector. Obviously, from the valuation perspective, we are more than 1 standard deviation away from the mean. In many cases, 1.5 to 2 times standard deviation in many companies. But to put it in perspective, there are 735 companies on Nifty having market capitalization of more than 3,000 crores. And as per data that I'm seeing, and which have positive EPS, 40% of those 735 trading at PE of more than 50. Why it's important? Why PE is important? Don't look at PE in isolation. Look at PE in consonance with or in relation to what is the profit growth expected over next 2 years, 3 years. So a company can create higher PE, but if the growth in the next 3 years is high, then on PEG basis, trailing PE divided by next 2 years or 3 years of growth in earnings, that PEG will look still reasonable. Suppose there are 2 companies, one company is growing at 50%, one company is growing at 10%, and both are trading at say 50 PE. Then of course the company which is growing at 50% will have a lower PEG. Same PE, suppose they have 50 PE both of them. So 50 upon next 1 year, 2 years growth of 50. 50 upon 50 is 1, whereas 50 upon 10 is 5 times PEG. So look at PE in relation to the estimated growth. And from that perspective, how many of these 40% of 735 companies having market cap of 3,000 crores and above with positive EPS can justify the valuation? See, today what happens is, in good times, as I said, market swings between greed and fear. So today, unless you have a multi-bagger, when you talk to any of your, and I'm not making this up, but I want to put this point across, in last 2 months, and I'm not at all being judgmental, but actually my own dhobi, electrician, and my mother's first cousin's son, who is a marginal farmer in Nasik, I got calls from all 3 of them asking me to tell them which stocks they should invest in, and they've never invested in a mutual fund. So typically the people who generally prefer investments in FDs, as someone said, now they want to learn FNO trading, and they are going to YouTube to take tutorials there. So we are at that stage of the market. And of course, you don't like your neighbor to get rich. And that sort of, when that starts happening, then I think, you start feeling sort of, so what is it? Where do I lack in my intellect? Where do I lack in my risk taking? Why is he getting rich? So this is sort of, the competitive Schadenfreude, Germans call it, taking pleasure in other person's pain. So if the reverse of that. So if it doesn't do well, I think you're happy. But now I think, why am I not doing as well? Why is my portfolio lagging? I think I had written in Economic Times, when Zomato got listed, I was on CNBC that very day. And I was there at 10 o'clock, there were going to be two young analysts who sort of, possibly would not have seen the cycles. And I was there in the earlier segment. So briefly I was asked about new age companies. And there's a time when a company called Nikola was listed in NASDAQ. And it got listed at a valuation higher than Ford and higher than Fiat. And actually, I'll share that article with Dere Saab and Dhruv Saab. They can share in the group. In ET had written, June 2021, that the company did not have any revenues, zero revenues. It did not have any profits. It did not have any revenues. It did not have a plant. It had only a prototype of a truck which was going to run for 600 miles based on that technology they were going to develop. The CEO is now in jail, but the market ascribed the valuation higher than Ford in NASDAQ, the mecca of technology. So, and then that's when I told them that when I was young in 1995 and I came in the markets, all the IT stocks had rallied similarly. And all of them in the subsequent 2 years fell by 95 to 98%. Z was 1,000, it became 50. Infosys was, I think, 10,000 became 2,500. Similarly, Wipro, TCS was not listed then. I'm talking about June 2000 and December 2001, in that 1.5 year period. Good companies came back, but it took them 15 years to come back to the same market cap. Wipro took, I think, 12 or 15 years. And many of them fell by the wayside. So many of them, that came later, that in 2008. I'm talking about 2000. A lot of people, youngsters would not even know. I'm talking about 99, 2000, the technology boom. Same thing happened in 2008 in case of power, telecom, infra, roads. How can you forget DLF has crossed that market cap on listing now. It got listed in 2009 or 10? 7. And it crossed the market cap just last month, that market cap. So you really have to be patient in not losing money. And that is DLF, the company having the largest land bank. Why? Because at that time, if you see the analyst reports, they were valuing those companies based on the total land bank that they held, and then how much could they build there, and take the today's price, 5% increase in rates, or whatever the number of increases, but essentially all the cash flows which would have come for 20 years, you discount them today, and then you ascribe a value. What happened to Unitech? 5 rupees, 500, 505. Parswanath, Omax, so many companies that you don't remember from those days. And similar thing in power, similar thing in telecom. I am saying that during times of excesses and euphoria, I think analysts and bankers come up with ever new measures to value a company to justify. Like in the second article that I wrote, one was on Nikola for ET, the second one I wrote for ET again, where I mentioned that during 2000, many companies did not have profits in the technology, media, telecom sector. So then you look at EBITDA. Many companies did not have any EBITDA. So there is no EV to EBITDA. Then you look at sales. Many of them did not have sales. So you could not use the market cap to sales. Then what do? Then you look at eyeballs. So how many of these had eyeballs? And based on that, valuation was ascribed. So this is what I cautioned people when Zomato was listed on CNBC, and I wrote an article again about that. But then I think, whenever you try to put forth views which are not in tune, I think, you need to be patient and just let the excesses sort of, work their way. So what is happening? Highly cyclical companies which have high leverage, which don't have any cash flow or not expected to generate the cash flow from operations or free cash flow for next many years, which have very low return on equity ratios, and which have the tag of PSU. They suddenly sort of are becoming a magnet for massive investments to happen. See, many of these PSUs have solid business fundamentals. But in markets, one must look at BVM matrix. Business fundamentals, how competitive is the business, what is the liquidity position, what are the runway for growth, what is the order book, what is the cost competitiveness that the company has, in terms of margins plus asset turn. And then that business can become a good business after all the evaluation you can buy. First bucket. But then you also have to look at valuations. A business, levers can be a good business, but can levers, I'm just taking a name, don't sort of know, but is lever a good stock to buy? Has the market already discounted next many years of earnings, and will that stock move sideways at best, or will it show correction before the market cap becomes attractive enough for new investments to flow in? This is what, in my opinion, the market in the current euphoria is overlooking. Today what's happening is, any order that any capital goods company gets, be it railways, be it defense, be it space, on many sectors, the market in its euphoria thinks that that order, which typically will be 3, 5, 7-year order to implement, there are a lot of risks of whether you'll be able, whether you'll be in time overruns, whether you'll complete the order in time, any cost overruns, will you be able to do it at the price that you have bid? Is there a full pass-through? Is there a partial pass-through? What if there's a change of government? For instance, there are a lot of these risks that you need to build. Just because a company has a market cap of, say, 5,000 crores, gives an order of 1,000 crores, doesn't mean that the cash flows are in your back today, because the market in its enthusiasm is increasing the market cap. Moment to see that order, people only look at in the various groups, this order, 5,000 crore market cap, 1,000 crore of order, increase the market cap by 1,000 crores. And the 1,000 crores is the top line. What is the bottom line? It is going to come over after implementation over 3, 5, 7 years. This is a classic case of markets being unhinged, extremely euphoric, and unsustainable. What is the point of inflection? But the government is going to come back, because it's and then when they come back, I think they are going to roll out capital expenditure programs, and then the long-awaited private sector capex boom will start happening. We have heard that. We have been there. Today is the time to be extremely circumspect in what you buy, and wherever you are sitting on large profits, at least start harvesting part of those profits. Now it depends on your risk profile. If you are a slightly higher risk taker, you could shave off only 5-10% of those profits. But if you are a conservative person who is retired and who has seen massive gains, then I would shave off more than that. Because unless you have booked the profits and parked them, it remains paper profit. I'm not advocating that you should start cutting your be premature in terms of taking profits. But all of us, I think, barring a few people who are very young, have seen many cycles, and we know that when the cycle turns, what kind of stampede you see among investors to get out. Because unfortunately people act like dumb driven cattle, me included, all of us, sort of. So, trend is a friend, fine, but 1.6 lakh crores has been the total sales by people who are insiders, promoters of companies, private equity guys who actually put in money and who actually presumably understand, not necessarily because Baiju's valuation is down by 95%, that's again sort of, the circularity. You buy a small stake in a company at a price, then again you top it up, slightly more you buy at a price which is 50% more, 100% more. And that's how the valuation game works. But on the reverse also it works, as you see in case of Byju's and many other companies. In listed companies also, especially in micro caps, small caps and mid caps, you need to be very, 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 very cautious. All of us hope that the party should never end and a company that's trading at 50 should trade at 70 and then 100 and 200. But what is PE? Those number of years you need to wait for you to get the money back. That is what PE is, through dividends. But all of us don't play on that, we play on the capital appreciation. So I am buying at 50, he is buying at 55, he presumes that he'll buy at 60 valuation. That's why it's going up. And so prices go up because of two reasons. One is increase in profits, which is EPS, and second is the re-rating that happens. So a new sector that emerges. Suddenly, some companies come up, large runway for growth. Consolidation happens. Everything else falls by wayside, 2 or 3 people remain. Telecom, food delivery. So now, presumably, now that only 2 or 3 are remaining, they will have the pricing power to increase prices, and that's how they earn more profits then. And that's how you justify the valuations. But even then, there's a limit beyond which a pushback comes from consumers or from the regulators. So that's why I think the earnings growth is nothing spectacular. Next 2 years, people are expecting a growth of, say, in FY25, mid-teens, 17-18% EPS growth in Nifty, and toning down further by 2-3% more in next financial year. And the about Nifty, large cap companies. Now mid-cap, because trading at a higher valuation, they justifiably need to have higher growth characteristics or earnings growth. But valuations, I think this is something, so further re-rating ruled out. Of course, because of geostrategic reasons, why are we where we are is also because China, the economy, the engine of growth for the global economy is sputtering. There is massive buildup of debt in the real estate sector out there, funded by shadow banking sector, and plus the dictator out there, Xi Jinping, has suddenly decided to go the Mao way, common prosperity, as in, he doesn't like a very emergence of powerful entrepreneurs. We saw in case of Jack Ma and many others followed. So as a result, he has, and plus the aggression that he has shown in the neighborhood, I think also has put off a lot of countries. Japan is a large investor, South Korea is a large investor. Now, of course, so that's why the term of diversifying supply chains away from or near-shoring them and friend-shoring them, coming to countries which are friendly to the West. So we are benefiting there. Although we still need to do a lot in terms of reducing our labor costs and other infrastructure costs, electricity costs. Labor and land are 2 factor reforms where we still need to do a lot of work. Because Vietnam is far more competitive as compared to us, so is Thailand. When you are competing for export dollars or export markets, you need to have these factor costs which must be extremely competitive. In many countries, the cost of electricity for industry is far lower than residents. Why? Because they feel that you supply them at a cheaper rate, large scalability will happen in those industries, more jobs will get created, the economy will get a bump up through increase in output. Land acquisition, we tried that in the very first term of Modi, he tried, but there was a backlash there, so he withdrew that bill. So the argumentative Indian and being a democracy where you always have differing views also holds us back. But that apart, we still need to do a lot of progress in reducing logistic costs, which government is doing, by putting so much money in roads, rails, ports, airports. So I think, to sum up, before I start taking questions, and if you have any questions on sectors, I can address them also, is that this is not the time to be adventurous. this is time to be extremely cautious, and especially any further investments in equities, keep a hawkish eye on what valuation you're buying a business at. Margin of safety is the most important concept in equities, and return of capital in the current market is more important than return on capital. So I think I'll end at that, and I'll invite questions on whatever questions you have.
So far, you have given a really gloomy and depressing picture of the whole Indian economy.
Not just Indian economy, I spoke about the global economy also, how the underpinnings of this large unhinged inflationary pressures that we saw, now it's abating. What was that? I also spoke about it.
So, is there really any hope about or any bright side of the picture?
I did say that massive investment in physical infrastructure like roads, railways, power transmission, I think has created conditions where logistic costs will come down, which will obviously benefit the overall costs. And as a result, will become more competitive in export markets, plus internally will become more competitive. So, it benefits everyone. Logistic costs coming down doesn't benefit only the construction companies that or the railway companies. It benefits the entire economy. Your cement costs will come down, steel costs will come down, your transportation costs come down, which in turn will help housing. When housing does well, it also helps all the companies that supply to housing, the house building companies, the different sectors that supply to houses. So broadly, I think, I would say that the glass is not empty as you put it. The glass is half full. And we need to sort of, address some of the factor reforms, as I told you, land, labor. They're extremely well in case of rolling out the PLI scheme. Like yesterday I was reading Panasonic's India head said that when PLI for air conditioners was thrown open, the target was let's reduce the import dependency, increase the indigenization level from 25 to something like 50. I think just a couple of days back article, it's already gone to 45%. So, so there are these benefits that you are seeing in case of, I'll just tell you the exact so it's already gone up the domestic value addition to 45% from 25% as per Panasonic Light Solutions India official. And the idea essentially is to increase it to 75%. So in a short span it's gone up from 25 to 45. So we are well on our way to reducing import dependence and adding value locally. This is only for ACs. Similarly, we are seeing a large amount of benefits accruing to many sectors, be it mobile, handsets for instance. Other electronic manufacturers have come up, and which also are not only catering to domestic market, but also as a launchpad for export markets. Defense, for instance, that I think not only will we start catering to the domestic market, initially first the whole target would be to indigenize, sort of, Atmanirbharta. But then I think all the middle income countries also looking towards India, where we can supply. But as I said, see, businesses and valuation, these are they are two different buckets. So companies would do well, but already has the market already discounted that? How many more years of growth has been discounted? That's important. A business could be a great business to buy, possibly at 20-30% lower valuation. That's the point I'm making. So there are pockets of growth in the economy. That's why we are the fastest growing economy at 6.5% this year. But then again there, consumption, which is 65% of GDP, investments under 15% to 20%, so 85, and the rest 15 is net exports. Exports minus imports. That consumption part, as I told you, again when you divide, the affluent sections are doing extremely well. So 10 crore people are doing very, very well. The rest 130, not so well. And within that again you have to do a dissection. Investments, government has been carrying the load of investments in infrastructure, roads, railways, power transmission, and waiting for the private sector now to pick up the baton and start spending on capex in steel, in cement, in other sectors, refining. That's where I think, one is waiting for last many years for private sector to start investing. Also what happened is after the successful implementation of the Bankruptcy Act, Insolvency and Bankruptcy Act, a lot of businesses which were not, which had become NPA were acquired by efficient manufacturers. Tata's acquired Bhushan Steel, so did Jindal acquire, JP Cement was acquired by, I think, Birla's. So all these companies were operating because of want of working capital and had become NPAs at very low utilization levels, or they were even shut. So when these guys came in, they got working capital support, got in efficiencies in those businesses. So had this not happened, they would have put up a plant. But first they bought these ailing businesses, improved their efficiency, and that's why the capex also got pushed back. But now we are at a level where we are operating at 75, 80% utilization levels. So companies should start now thinking about putting up capex for growth, to take care of growth for the next 5 to 7 years. So that's why I think we are at a juncture where growth will happen. It has to be more equitable growth, and we still have work to do in terms of becoming more competitive on the exports. Yes. Yeah, so I wish I was Bijan Daruwala or Nostradamus, but what I can, because the reports would have you believe, I think one of the secretaries has given us an interview that there are possibly money laundering charges that they are considering. So we don't know exactly, because RBI, all of us were only speculating. There were issues with KYC, onboarding of customers, they were not stringent. And secondly, also data storage. When RBI is very, very touchy about that. They would like the data storage to happen within the boundaries of India. So they must have found some issues or infractions out there. Now the issue is that there are some reports that say that whether the license also hangs in balance of the banking license. So it will depend on the outcome of the regulatory action. How stringent is the follow-up action? If the license continues and they are given time to remedial measures, then I think, there is value there. Because there is some value for other businesses. What happens, the reputational risk, it takes a hit, and then the competitors are waiting. The Google Pay and the Phone Pays are waiting, as happens in Hindi business. So you are waiting, to grab market share. So then I think your value of your underlying business also takes a hit, because, your revenue generating customers, like Vodafone, what's happening? Every month they are losing customers to Airtel and Jio. A point will come where that will start impacting on the network quality. And especially in telecom, where you need to keep up investments, both on OPEX and CAPEX. Newer licenses for 5G, they have not yet bid for. So I think, in case you're holding, I think there is some comfort I can give you. On Monday it will be around only 10%, because they have reduced the low circuit level from 20 to 10. So I think, so less, or yeah. Sometimes I always feel like death by 1,000 cuts. Let it happen, in one day rather than waiting for 2 days.
Who's buying the market? Because the buyers are buying the market.
Before November 16, before demon, the total size of systematic investment plan was 3,000 crores. Inflows from retail investors into Indian stock markets. Last month it was 17,000 crores. So to answer your question, ma'am, 17 into 12, I'm not good at maths, but whatever the number is, 15 is to 25. So around 2.5 lakh crores is basically the inflow that comes if the retail investors maintain the same fervor and belief in markets basis, 2.5 lakh. Add a lakh crores more that will come from insurance companies, 3.5, plus NPS, EPFO money. So all put together roughly 3.5 to 4 lakh crores. So these days when people say that FIs don't matter, because 10 years back, had FIs sold what they sold in the markets in the last 3 years, the market would have, remember Lehman days, the market had created by 50%. But this torrent of flow of 3.5-4 lakh crores coming from Indian retail investors through SIP, insurance, EPFO, NPS is essentially providing a bulwark of support for the market. Now the question that you need to ask is, how sustainable is the 17,000? Because the number of investors in the market has gone up by 8 to 10 fold from COVID lows. Many youngsters, they have taken a liking for trading and they haven't actually seen a prolonged bear market. See, people like you and me have seen long 2 to 3 year period when all hope is lost, and that's when bottom gets made. These guys have seen a 10% drop and then 20% rise, 15% drop and 40% rise. So one needs to, that's why, and this is not only in India but even overseas, the profile of buyer has become younger. Tech savviness has led to the efficiencies of investing being far higher than what it was previously, and that's why the volatility also goes up. Algo trading has gone up. So I think as long as this torrent of money continues to flow, at least the corrections will be shallow. But then we know that this money is coming in because they are seeing the returns in last 3, 6, 9, 12 months. How sustainable are those returns? Because if for some reason, which neither you nor I know, the point of inflection and markets, already we are seeing funding winter. You must have heard of funding winter, but that is for unlisted companies. So all the companies that were funded by venture capital funds and private equity funds, for the last 2 years they are shivering, funding winter, because they are not getting any, large flows have stopped. The go-go days of 2019 and 20 are well and over. That's why Baidu is down to 5% of its peak valuation, and many companies in America and in India also see losing valuation. But in listed space, that has not happened. And plus, a lot of unlisted companies, they are reluctant to mark down the investments. Unless they are forced. They need to raise funds, again, because they are losing a lot of money. They are hardly making any money, for instance. Then they go for further round of funding. And the guy who wants now come in, he'll extend his point of view, saying, look, those days are over now. So I'll come in only if I value 40, 50, 60% lower, depending on each franchise. But in equity and listed markets, on a daily basis, it happens. But here, the massive fund flow is happening. So 3,000 crore has become 17,000 crore monthly. That in single point, plus the other flows coming in. And plus, as I said, because a lot of money is flown out of China, it has to find its way into other emerging markets. So India is getting its fair share, along with Taiwan, for instance. Japan has come back after many years, became a developed market. So India today, nothing can go wrong from foreign investors' perspective, because all of them, they look at top-down investments. You ask a lot of foreign investors, they'll invest Indian paisa dalna hai. Sectors, they'll either mimic the index, or they'll look at some of the large mid-caps and they'll invest there. Bottom up, very few, a lot of FIs do bottom up also, but many of them do top-down investments country-wise. Then they look at some top sectors, top 3 companies in each sector, let's put some money out there. Whereas in retail investors in India, no large caps. Mid, better still small, better still SME. Yeah, she has a question. Right. I'll be brief in answer, please. I can complete one more. Yeah.
I just wanted to ask you, you have recommended that pay attention to business fundamentals, but more importantly, valuation.
Well, and then also market interest factors, the third point, BVM. Market interest factors means basically what is the liquidity, which is very positive for India today. You know, both domestic as well as foreign, because we're at apple of the eye for foreigners, and investors also they can't get enough of equities, especially small and mid caps. Then there are research coverage. More and more analysts are covering now India, plus within India, different sectors. Like previously, I would say 10 years back, there was hardly any coverage for, say, agrochem, 15 years back. Today, there are so many analysts covering agrochem, and so many other sectors. EMS was not there. So many new sectors are getting highlighted and covered by more analysts. So research coverage is one part. These are market interest factors. FI holding, government is more liberal in terms of increasing FI holding in many sectors, so on and so forth.
My question was that in the valuation, to understand the valuation of a particular organization or a sector, what kind of parameters should we be paying close attention? Why they may vary based on sector and specifics. But there would be few that would be relatively similar approach
So,
that can look at and say, yeah, this is a good company to put money in.
see, the first foremost is corporate governance. I think that is, you should never compromise on the management because, you know, as I say, you can live with an inefficient promoter but not a dishonest promoter. So, sort of, that's most important. But of course, ideally, as an investor, you should have a efficient, ideally, obviously, you need an efficient promoter also. So, the corporate governance is important. Then what is the runway for growth for that sector? How big is the growth opportunity? The third thing you look at is how competitive is the industry. Initially, in our emerging sector, a lot of players come in. Then there is fierce competition. And then there's consolidation because people follow the wayside, telecom, you saw in case of, say, food delivery. There are so many sectors it happens. So the people who stay back have the staying power and funding deep pockets and who emerge as the winners or leader and for first couple of them, then they get pricing power. Consolidation happens in that industry. Look at competitive intensity. Look at how efficient they are in terms of their margins, in terms of asset turn, how they're able to sweat their assets. So these are all financial parameters you should look at. And then debt levels. Are they relying excessively on debt? What are the return ratios? Return on net worth, most important. Return on capital employed. These two things you should look at. And then you look at valuations. So how are they vis-a-vis the peers? And then overall, how are they vis-a-vis market and then peers, within peers? And then every sector will have its own specific valuation matrix to focus on. For cement, it will be enterprise value to EBITDA or enterprise value per ton. For banking, it will be price to adjusted book ratio. What is the net interest margin that the bank, why are the banks not doing so well? Because the cost of deposit, for all the banks in last numbers that you would have seen, the credit growth is far more than deposit growth. Which means there's scramble for deposits. So obviously in this scramble, we are beneficiaries. We will go to the bank, will give higher return. So deposit rates are going up. So your net interest margin is going to come down. Your cost of fund is going up. So that's why net interest margins have peaked or plateaued a quarter back, and now they are going to come down. So that's the first thing. Secondly, asset quality is pristine because you already provided 10 lakh crores of bad assets have been provided. So how much more can provide? But now in last 3-4 years, there has been a massive increase in unsecured credit, personal loans, credit card loans. RBI has been warning NBFCs and banks to no avail, that's why they increase the risk weight. Now whether this would necessitate a drawdown on the part of these banks or NBFCs if cost of funds also goes up. Suppose credit growth starts normalizing and asset quality issues start coming back to fore, then your projections of profits for next 4-5 years all will get revised. And then the valuation will start suddenly looking unsustainable. So that's how correction can also start. Correction can start from simple. You are discounting future profits. But if those profits are based on certain assumptions, if those assumptions don't pan out and profits start getting slashed, then the current prices have to reflect that, which price has to go down. So that's what is ailing banking sector today. HDFC Bank, it's one of the best run banks. But why has HDFC Bank not given any good returns in the last couple of years? Because when you merge an entity of the size of HDFC with HDFC Bank, which are two formidable large entities. And HDFC Limited never had access to savings deposits or current account deposits. The entire funding was borrowings through bonds in the market or through FDs, high cost. They did not have SLR, CRR. That was an advantage. But the cost of funding was far higher than HDFC Bank. So when you merge two entities of equal size, you have to reprice, the liabilities of HDFC have to be now wound down and replaced by savings and current account deposits. Overnight you can't increase your, even if you're HDFC Bank, overnight you can't increase your deposits to replace the liability of HDFC Limited when all the other banks also scrambling for the same type of deposits. Which means your net interest margin is above 4% for years on end. It's today 3.5. Will it remain there or will it further go down? And then why should you get that higher valuation? So this is how the de-rating starts happening. Till now all of us are saying re-rating. I'm not talking about HDFC Bank, I'm talking about overall market. The de-rating starts happening because you have been too cocky in discounting future earnings. And when those earnings start falling far short of market expectations, then the de-rating starts happening and double whammy. Profits get slashed and the valuation that you are giving, the PE or price to book, starts coming down. So both work. In a rising market, it works positively. In falling market, it works adversely. And remember one thing, human psychology is such that we get scared more. Right now, all of us, are in that greedy zone. But once the scare starts, then you would rather be out of that yesterday. I think I hope that I don't go back as a prophet of doom.
Thank you very much, Ajay. This was really, you have highlighted quite a few things with respect to the budgetary statement and how it need to be looked at. Plus, you have made us aware and cautious about where the valuations stand as of today, especially in the micro, small and mid cap. So thank you very much for taking your time out and, spending us with it. Yes. So it's our pleasure. Thank you.